Okay folks, in this video we're going to review the 12 most recent acquisitions of commercial-stage oncology-focused biopharma companies as well as AGIO's sale of its oncology business to Servier. For all 13 transactions, we will compare the enterprise values paid to the respective gross margin forecasts provided the buyers by the Acquiree's management and calculate the associated rate of return. To follow along, you must understand basic net present value theory which, put very simply, says the real value of a product, or any asset for that matter, is the present value of its future cash flows at some rate of return, also known as the discount rate. This analysis of the 13 acquisitions will assume the enterprise values paid are the net present values and the Acquiree's gross margin forecasts are the future cash flows. Calculating the discount rate, shown here as X, is then very simple. In plain English, the analysis assumes the company is being acquired for its product's future gross margin dollars just as if the acquirer was buying an income stream. You decide for yourself if it is relevant. There are countless other assumptions that go into a purchase price in these M&A transactions. This is only one of them, but future cash flow expectations are obviously important. This analysis may provide a range of valuation expectations for peers. For example, one could apply the range of discount rates from these 13 transactions to long-term gross margin forecasts of current independent commercial-stage oncology-focused biopharmas as one tool of many to estimate their potential valuation in an acquisition. We are otherwise not going to judge nor offer any opinions. We are merely sharing the math. By commercial stage we mean those with at least one FDA-approved cancer therapy. Many believe gross margin forecasts are very relevant, especially in commercial-stage oncology-focused M&A valuations, because acquirers are essentially buying a product that, more or less, sells itself since it treats cancer versus say marketing a new acne prescription medicine. To those that say a multi-decade gross margin analysis does not consider pipelines, we tell you the value of an Acquiree's pipeline should eventually manifest itself as revenue. Science is wonderful, but if it cannot generate revenue, then how much is it worth? That being said, and to be crystal clear, by no means do we suggest investors only consider an entity's product revenue and gross margin forecast. Last, we will share traditional revenue and gross margin multiples from all 13 transactions at the end of the video. Remember folks, though the voice is automated, the three of us producing this video are human beings who make mistakes. You should always recheck our math for yourself. This is not investment advice anyways. This is all for entertainment purposes only. Let's get right into it and start with AbbVie's $10.1 billion acquisition of Immunogen announced November 30, 2023. Immunogen had about $500 million in the bank at the time with zero debt, so the transaction's enterprise value was approximately $9.6 billion. Per Immunogen's subsequent 1-4A filing dated January 2, 2024, we see Immunogen's management provided AbbVie the 17-year financial forecast through the year 2040. Here are the product's sales, total sales, and gross margin forecasts by year as prepared by Immunogen's management on a Microsoft Excel spreadsheet. We excluded 2023 financial forecast data because the transaction was announced on November 30, 2023, so we assumed a March 1, 2024 close. Okay, simple math using Excel, a collective net present value of $9.6 billion on these Immunogen gross margin forecasts over the 17-year period assumes a 12.29% or call is 12.3% rate of return or discount rate. Very simple. Recalculate it for yourself. Again, it is up to you whether or not it is relevant. Now, we'll share our work here so you understand the mechanics of this worksheet. Using a 12.3% discount rate, shown here in yellow, and these mid-year convention factors, we use the standard Excel formula, referencing the discount rate and convention factor, to come up with the NPV factor of $1 for each year in the forecast. For example, see here in the year 2032 Immunogen forecasts $1.561 billion in gross margin. The present value of $1, 8.25 years from now, at a 12.3% discount rate, is 0.384. Multiply the $1.561 billion in fiscal year 2032 gross margin forecast, we'll say in row AAE, by the NPV factor of 0.384, shown here as 38.4%, we'll call it row B, yields a net present value of exactly $600 million. Put a different way, if you deposited $600 million in the bank today in a certificate of deposit earning 12.3% interest, you would have exactly $1.561 billion in 8.25 years. Add up the NPVs of all 17 years of future gross margins forecast and you get exactly $9.6 billion. We've been doing this for years. This is standard cash flow analysis. For the first year, the analysis assumes the transaction closes roughly 3 months from the date the acquisition was announced and adjusts year 1 accordingly. Yes, this analysis does not consider any terminal value, which is another reason it is not perfect. All the same, you see the NPV of Immunogen's fiscal year 2040 gross margin forecast, at a 12.3% discount rate, is $232 million. This $232 million is not 3% of the purchase price, and we see management forecasts sales to be decreasing by then. More important, this is 17 years from now. Does anyone truly know what will happen 17 years from now? As important, this analysis does not consider the costs to create the sales that generate the gross margins, and we are not referring to selling costs. To put the risk in perspective, here are the growth rate assumptions incorporated into Immunogen's product sales forecasts, right here above the respective years. See here how Immunogen's management forecasts product sales to grow 14% and 21% in the years 2032 and 2033, respectively. This is after much slower growth in the years 2030 and 2031. Actually, wait a second. Look at 2031's sales versus 2030 sales. Immunogen's management forecast product sales to decrease slightly in the year 2031. See it here again in the SEC filing for yourself. Folks, we are not experts on Immunogen's business, but common sense suggests some kind of clinical, regulatory, or other, quote-unquote, win is needed to be the catalyst for the renewed product sales growth in 2032 after 2 years of virtually no growth in product sales. This analysis does not consider any incremental costs to make those, quote-unquote, wins happen. Also, are we certain these, quote-unquote, wins will happen? These risks generally, and of course not all of the time but again generally, manifest themselves in the discount rate, again also known as required rate of return. The higher the discount rate, the lower the net present value, and vice versa. One more thing while we are here, we are well aware that in the real world an acquirer will use a lower discount rate on near-term forecasts versus say 10 or 12 years into the forecast. Here we are looking at the gross margin forecast over the 17-year period at the same rate. It is not perfect but could be a barometer when assessing peers. Second time, this is not investment advice. Okay folks, next up on October 8, 2023, Bristol Myers announced it was buying Mirati Therapeutics for $4.8 billion. Per this press release from Reuters, Mirati had $1.1 billion cash in the bank, so the transaction's enterprise value was $3.7 billion. Here is a snapshot of the 21-year financial forecast provided Bristol Myers, prepared by Mirati Management, per Mirati's subsequent SEC filing. Here's Mirati's revenue and gross margin forecast. Here are the growth rates assumed by year on top. Wait a minute, look at that. Mirati's management forecasts sales to surge in the year 2027 and 2028. You have to wonder what, quote-unquote, wins are needed and what costs are necessary to make that growth happen. That is of course if the growth in the years 2027 and 2028 happens. Okay, using the exact same mechanics from the Immunogen example, a discount rate of 21.395% on this Mirati gross margin forecast results in a collective NPV of $3.7 billion. Yes, we know there is a CVR worth up to $1 billion that we are excluding from this calculation, including the $1 billion CVR, and at the same time ignoring the CVR's present value, since we understand best case the CVR is paid years from now, would result in an enterprise value of $4.7 billion, a discount rate of 17.802% on Mirati's gross margin forecasts. Now the gross margin forecast may or may not assume results that trigger payment of the CVR, results in a collective NPV of $4.7 billion. Again, this analysis does not consider any terminal value. Actually, real quick, would you kindly take a moment and follow us here on YouTube? We genuinely appreciate followers. Next up is CTI Biopharma or CTIC. On May 10, 2023, Sobi announced it was buying CTIC for $1.7 billion. CTIC's cash and debt was awash, so the enterprise value was also $1.7 billion. To move this along, we will not share a copy of the financial forecasts from all Acquiree SEC filings. CTIC is a great example of a NPV calculation because it appears CTIC's Vonjo patents expire in either late 2033 or early 2034. We say it appears so, but what we do know for certain is that CTIC management forecasts CTIC's gross margin to fall 75% in 2034 from 2033. Again, CTIC is a great example of the purpose of this analysis because it appears CTIC forecasts minimal terminal value, at least compared to Vonjo while patent protected. In any event, a discount rate of exactly 21.58% on CTIC's gross margin forecast results in an NPV of $1.7 billion. We also think CTIC is a great example for those peers that clearly have only one product of value, more so than any other transaction we will review. We suspect Sobi is paying $1.7 billion only to buy this Vonjo-driven gross margin forecast or profit stream. Next up is Pfizer's acquisition of Seagen. This was obviously a big one. On March 13, 2023, Pfizer announced it was buying Seagen for $43 billion. Seagen had $1 billion in cash, so the enterprise value was roughly $42 billion. Unfortunately, Seagen only provided a financial forecast through the year 2034. We see Seagen management forecast its product sales to peak in the year 2032 and the subsequent decreases are relatively small. The fiscal year 2034 gross profit forecast is simply too much in potential terminal value to ignore like the others, and with 4 FDA-approved oncology-focused therapies and, we assume, several late stage in the pipeline, we have no idea when Seagen's sales could peak, nor can we even provide an educated guess. That being said, and only for the sake of argument, if one were to use a multiple of 6x on Seagen's 2034's gross margin, the terminal value would be a hair over $56.7 billion. Remember, we do not consider the costs to get there. Nonetheless, if we assumed a terminal value of $56.7 billion, then the resulting discount rate on the Seagen transaction would be 13.776%. This is probably way oversimplified, or worse, dead wrong, but it's certainly not a 28% discount rate. In any event, Seagen was truly a one-of-a-kind transaction. We would not consider Seagen as a peer for any existing commercial stage oncology-focused biopharma anyways. Okay folks, next up, on October 18, 2022, LG Chemical announced it was buying AVEO Pharmaceuticals for $566 million. Now recall AVEO's cancer therapy called Fotivda was finally approved on March 10, 2021. We say finally because, as we recall, AVEO first filed for Fotivda FDA approval in the year 2013, to which it got a complete response letter. We understand Fotivda's patents expire in 2027, which is more or less consistent with when AVEO management forecasts its revenues to peak. AVEO management prepared this revenue forecast but did not provide cost of sales nor a gross margin forecast, so this analysis assumes an 88% gross margin consistent with AVEO's actual fiscal year 2021 and 9-month 2022 gross margin rates. We know from AVEO's financial statements that cost of sales included royalties due third parties, so this analysis assumes an 88% gross margin on all sales through the year 2038. Long story short, a discount rate of a whopping 51.4% applied to this gross margin forecasts results in a collective net present value of $566 million. Look folks, we know that seems awfully high, and perhaps we're missing something, but see it here for yourself. AVEO forecasts $491 million in 2027, 2028 sales. Its $566 million acquisition is barely 1 times 2028 sales, so the high discount rate makes sense proportionally to the revenue multiple. For what it is worth, AVEO is an outlier. Next. On December 20, 2020, AGIO Pharmaceuticals announced it was selling its oncology business, including Tesaro, to Servier for $1.8 billion. Here is the financial forecast AGIO's provided Servier. Now AGIO's did not include a gross margin forecast, but we know actual product gross margins were 98% before the sale, so this analysis assumes 98% gross margins. Now with AGIO's product forecast, notice sales first peak in the year 2032 and then start to grow again in the year 2035, then peaking again in 2039. Like some of the others, we suspect some future, quote-unquote, win is needed to restart growth. This analysis does not consider the costs to restart that growth. In any event, the discount rate was 22.23% on these future gross margins to come to a net present value of $1.8 billion. Okay, next up is another big one but still a one FDA-approved product company. On September 13, 2020, Gilead announced it was buying Immunomedics, and its Trodelvy therapy approved for breast cancer 5 months earlier, for $21 billion. Immunomedics had about $900 million cash, so the enterprise value was $20.1 billion. Here is the 14-year financial forecast prepared by Immunomedics Management. We see Immunomedics Management forecast product revenues to peak in the year 2033. So the answer? Using a discount rate of 17.71% on these Immunomedics gross margin forecasts results in a collective net present value of $20.1 billion. Now we see the present value of Immunomedics fiscal year 2034 gross margin forecast, at a 17.71% discount rate, is $617 million. Now that's a big number to ignore for a terminal value, but again this analysis does not consider terminal values. We'll tell you one thing though. Immunogen's management forecast product sales to drop 28%, and gross margin to drop 27%, the year after sales peak. If we assume 20% drops in gross margins each year for another 4 years after patent loss, it adds roughly $1 billion in enterprise value and the resulting discount rate is only 1% higher. It is certainly not 4% higher, so to us 18.8% is clearly very close. Also, remember most analysts agree the value of any asset or product or company is the present value of its future cash flows. Here, right or wrong, we are using future gross margin as the future cash flow. Immunomedics provides a good example of where the anticipated value really comes from using cash flow analysis. You see here the net present value of Trodelvy's gross margins between fiscal year 2025 through 2027 are north of $2 billion per year. The further you go out, the lower the present value and resulting contribution to valuation using this methodology. Okay, next up is Pfizer's $11.4 billion acquisition of Array BioPharma announced on June 17, 2019. Array's Braftovi and Mektovi were approved for certain melanomas 1 year earlier in June of 2018. We apologize if this computer-generated voice is mispronouncing these names. Array Management provided Pfizer this 18-year financial forecast that included these gross margins by year. Again, using gross margin forecast as future cash flows, a discount rate of 9.733% applied to these gross margins results in a cumulative net present value of $11.4 billion. We should note Array did not provide a 2019 forecast. We assumed an October 1, 2019 close and assumed $75 million in Q4 2019 gross margin, which seems close considering Array's 2020's gross margin forecast. We see the present value of Array's 2037 gross margin forecast is $245 million. Again, we are ignoring terminal value, but in this case it is 2% of the enterprise value, so likely not material. One more time, would you kindly take a moment and follow us here on YouTube? We genuinely appreciate followers. Next up is Eli Lilly's $8.1 billion acquisition of LOXO Oncology. LOXO had $600 million cash, so the enterprise value was roughly $7.5 billion. LOXO's larotrectinib was approved 6 weeks before the transaction was announced. 6 weeks, folks. We read somewhere the transaction was put together over a 2-week period around the holidays so it could be announced at the 2019 JP Morgan Healthcare Conference. Okay, in any event, LOXO Management provided Lilly this 15-year financial forecast and these gross margins by year. Now listen folks, a discount rate of 8.606% on these gross margins yields a cumulative net present value of LOXO's gross margin forecast of $7.5 billion. That's the lowest discount rate we've seen to date. Now we see LOXO forecast sales to peak in the year 2031, which was year 13 from the date the transaction was announced, but with LOXO we do not see a huge drop after peak sales. We see the NPV of their gross margin forecast in the last year is a number too big to ignore a terminal value. Of course, what happened 16 years from an acquisition date is anybody's guess. We do not know LOXO's business well enough, so, like we did for the Pfizer Seagen transaction, we'll use a 6x multiple on LOXO's year 15 gross margin as a wild expletive guess. Doing so would change the discount rate from 8.606 to 12.377%. Folks, this is not perfect, but, for some perspective, discount rates in the mid to high 20s is the norm in non-oncology M&A. Watch our video coming soon doing the same analysis on commercial stage but non-oncology focused biopharma M&A. Okay, let's fly through the last 3 because they are dated from 2018 and 2017. GSK announced it was buying Tesaro on December 3, 2018 for $5.1 billion. The press release notes the $5.1 billion includes the assumption of debt, so we are assuming they mean 5.1 in enterprise value. As you see here, Tesaro provided a case AAE and case B forecast. In both 12-year projections, Tesaro Management forecast revenues and hence gross margin to grow every year through the end of the forecast period in the year 2030. Okay folks, with no judgment nor opinion, the discount rate on the case AAE forecast is 25.107%, case B was 19.983% and the average of the two was 22.418%. Remember, we are ignoring terminal value, which, in this case, appears not to matter because the discount rates are already higher than all the others except for AVEO. Making assumptions about a terminal value would only push the discount rates higher, but we'll tell you a simple Google search on Zejula's patent expiration notes generics won't be available until the year 2039, so maybe we are missing something. Okay, next up is KITE. On August 28, 2017, Gilead announced it was buying KITE for $11.9 billion. With roughly $800 million cash in the bank, the enterprise value was about $11.1 billion. Now yes, technically KITE was not a commercial stage biopharma when acquired but had an active PDUFA date within 3 months. KITE Management provided Gilead this 15-year financial forecast with these gross margin projections by year. The resulting discount rate comes to 18.692%. 7th time, this analysis assumes no terminal value. We should note KITE provided a set of quote-unquote adjusted projections that forecast revenues at roughly twice the sales forecasts that went into this discount rate analysis. Now we know now that the KITE acquisition has not worked out as planned, but, at the time, you have to wonder if the adjusted forecasts were considered. All other things being equal, you double the gross margin forecast, you have the discount rate. Last up is the Takeda acquisition of Ariad announced January 9, 2017 for an enterprise value of roughly $5.4 billion. Ariad's management provided Takeda this 21-year financial forecast with these gross margins by year. The resulting discount rate comes to 19.647%. With Ariad, we see here clearly there is no terminal value. Now folks, we were initially going to exclude the Kadmon Holdings acquisition. Recall Kadmon's Rezurock was approved 7 weeks before Sanofi announced it was buying Kadmon for an enterprise value of $1.9 billion. We are not 100% sure Kadmon is technically oncology focused, but we know Rezurock was priced at $15,500 per month. The average duration of treatment was 9.2 months in its 2 clinical trials, and there are roughly 5,100 patients who will likely use Rezurock per year. Assuming an 80% gross to net, the annual opportunity appears to be just over $500 million a year. Follow the math here. Put simply, Kadmon's model appears consistent with oncology. Whatever the case, Kadmon provided Sanofi this 13-year financial forecast that of course included a sales forecast, but, unfortunately for us, not a gross margin forecast. Because Kadmon was acquired so soon after approval, we do not have any actual gross margin data points, but we know Rezurock is a pill. Pure pill manufacturers generate gross margins north of 95%, so that's what we will assume here. Last, Kadmon provided a forecast through 2034, which is also their year of peak sales. Now if we just assumed 95% gross margins and 0 terminal values, the resulting discount rate is just over 20%. We see any terminal value is minimal. Folks, that's all 13. Please let us know in the comments if we missed the acquisition of any commercial stage oncology focused biopharma since January 1, 2017. We did not include Spectrum's merger because it was not an acquisition. We did not include Lexicon's sale to Tesaro Therapeutics because it was small dollars all things considered. Verastem's sale of Copictra to Secura was for less than $100 million upfront. These 3 would not make good comps for our analysis because we will use these ranges of discount rates on peers with multi-billion-dollar valuation expectations. Okay, so if that's all 13, then let's review. We added a column to this worksheet to reflect the discount rates assumed on these gross margin forecasts. Folks, these discount rates are not debatable. How to interpret the discount rates is subject to debate, but otherwise the math is the math. Of course it is up to you to decide if the net present values of product gross margin forecasts are relevant in valuations. Now clearly the lowest discount rates noted were from the Array and LOXO transactions, both south of 10% and both in the year 2019. Since then, the discount rates have been more or less between 19 and 21%. Seagen and AVEO are outliers as well as the most recent. Immunogen was 12.3%. Incidentally, we know the second bidder on Immunogen offered $23 a share versus AbbVie's $32 bid. Had AbbVie not bid and Immunogen opted for the $23 a share offer, the resulting discount rate would have been 17.2%. Let's just note in green when each Acquiree forecast its product revenues to peak. Isn't that interesting? Most sold when there was 12 or 13 years left on patent, or better said 12 or 13 years until sales should peak. Now also remember sales growth, at times irrespective of gross margins, are also important considerations. We will also note the like discount rates for commercial stage but non-oncology biopharmas were much higher as a group than oncology. For example, remember the GW Pharmaceuticals acquisition back in February of 2021 at the height of the XBI? The discount rate was 25%. ChemoCentryx from August of 2022 was 23.3%. Global Blood Therapeutics a week later was 25%. The lowest discount rate applied to a gross margin forecast in non-oncology was Bristol Myers' acquisition of MyoKardia, for which the FDA submission had not been filed. Follow us so you'll see when we post our video analyzing the discount rates applied to the gross margin forecasts prepared by the Acquiree's management in all commercial stage but non-oncology focused biopharma M&A transactions since January 1, 2017. Big picture, in oncology the discount rates using gross margin forecasts as future cash flows ranged from, let's say 12.3% from Immunogen at the absolute best to 22%. The 2 south of 10% were, big picture, outliers, or at least appear so to us, and both took place in 2019. To us, this is what makes estimating oncology valuations difficult. Look at these ranges in discount rates. What is an appropriate discount rate for say SpringWorks Therapeutics or Iovance or Deciphera Pharmaceuticals? Is it 12.3% like Immunogen or 21%? What rate is chosen has a gargantuan impact on valuation. This is why, at best, in our opinion, one can only come up with credible ranges, again ranges, of valuations. For another perspective, let's have a quick look at Lazard's fairness opinion on the Immunogen AbbVie transaction to see this another way, using revenue multiples instead of discount rates on gross margin forecasts. See here, Lazard says, and this is not Night Owl Biotech offering an opinion, but directly from the investment bankers hired by Immunogen. Lazard notes a range of year 5 revenue multiples as low as 3.2 times in the 25th percentile to as high as 4.9 times in the 75th percentile. Immunogen was acquired for an enterprise value of $9.6 billion, which was 7.9 times its year 5 revenue estimate. Which year 5 revenue multiple would be appropriate for the commercial stage oncology focused biopharma you are considering? 3.2 times, 4.9 times, or 7.9 times. Not only do you need a revenue multiple, but you also need credible revenue estimates. Let's look at ranges of valuation estimates from one more professional opinion. Here is a snapshot of Centerview's review of actual year 4 revenue multiples paid in peer commercial stage M&A transactions and their fairness opinion on the Bristol Myers Mirati transaction. You see here. Actually, let's make this a little bigger. You see here Centerview reviewed these acquisitions. The top 5 were non-oncology and the bottom 3 were oncology. You see the range of 4-year revenue multiples in non-oncology ranged from as low at 4.7x for ChemoCentryx to as high as 8.3x for Gilead Bio. For the 3 oncology-focused acquisitions, you see Tesaro was acquired at a 5.7x year 4 multiple where LOXO was at 10.7x. These are rather large ranges, don't you think? This is why we suspected discounted cash flow analysis was more appropriate. Perhaps we are right or perhaps we are wrong. You decide for yourself. We conclude at best you can calculate ranges of potential M&A valuations for peers. Our first analysis will be on SpringWorks Therapeutics coming very soon. Last up, here is a summary of traditional revenue and gross margin multiples for all 13 commercial stage oncology-focused transactions. Here in column A we note the number of years from the date the transaction was announced until sales are forecast to peak. In column B we note the enterprise value paid. In column C we provide the total gross margins forecast over the following 10-year period. In column D we note the average gross margin rate over the 10-year period. In column E we note the ratio of enterprise value paid to total gross margin dollars forecast. some would call a 10-year gross margin multiple. To follow the math, take the amount in column B and divide by column C. In column F we note the total revenues forecast over the 10-year period following the date the acquisition was announced. In the next column we note the enterprise value as a multiple of total 10-year revenues forecast. To follow the math, divide column B by column F. In the next column we note the discount rate on the gross margin forecast. This is what we walked you through during the first 15 minutes of this video. Now you clearly see a correlation as you would expect between the discount rate and the 10-year revenue multiple. The columns to the right should be self-explanatory. Now in a later video we will bring all of this together because we will include growth rates. You will find it very interesting and telling. For now this is the end of sharing the raw data and analysis. We hope you found this video useful or even better informative. Follow us here as we will estimate SpringWorks Therapeutics' potential valuation using sourced estimated gross margin forecasts as well as traditional revenue multiples. We will also share our review of discount rates applied to gross margin forecasts in all acquisitions of non-oncology focused M&A transactions since January 1, 2017. Please take a moment to follow us and leave any suggestions or thoughts in the comments. Thank you.